In this section, we're going to use what's called fundamental analysis. We're going to look at the fundamentals of a company or organization and see how they're doing, some measures or ratios to see how the company is doing, and what's really important to see how that company compares to other companies that we might want to invest in. One thing that's very important when you're looking at any ratio within any company is to compare it to its peers within its industry. You could compare it to the wider market, and that's okay to compare to the big wide market too, both domestic, international, whatever. But you really want to hone in on its comparable competitors that are out there, so you can kind of see who's maybe doing well or who's maybe underperforming, and look at how they're doing within the industry. So one thing, and I'll talk about this probably a couple of times as we get into the ratios, just remember to really compare it within its industry and versus its competitors. Now we've got the ratios broken down into 5 big categories that, there's a very traditional way as far as looking at, and then you have these individual ratios or numerical measures within these 5 categories. First category we're going to look at is valuation, or that's simply the price of the stock. You're looking to evaluate the company, you're looking to evaluate its stock price, maybe its dividends and how its dividends compare and how those future things might continue to go on. So you're really trying to get a price valuation to compare it to the pricing valuations of other companies, so you can make a good choice based on what might be a good price for an organization or company, what might be a good fair price, something that you can maybe hopefully grow and appreciate that price. So we're going to look at valuation. Then we'll look at also profitability, which is pretty simple. It's what it says. How profitable is the company? What are some measures that we can use to measure profitability and compare it? Next is liquidity. We're looking at how liquid the company is, looking at things like current ratios and current bills, more so looking at things like current bills and how they can pay their current bills. Are they very liquid, or are they carry on a good amount of debt and are having a hard time making their current business bills or current things? So that's looking at liquidity. And then we'll look next at debt, which really goes even beyond liquidity and looks at more like solvency. Is this company solid? What is its debt to equity ratio? How can is it solvent enough to survive? And you want to see if somebody's maybe carrying high levels of debt, for example, that might be precluding it from maybe making future investments. Many companies take on debt, and debt's an okay thing, to invest in future investments with the idea that that debt they're taking on is going to pay off in a bigger way. But if you have too much debt, it can be a real drag on an organization and a real warning flag for us as the investor. And then lastly, we'll look at how efficient is the organization? How is its operating measures? How is it doing compared to its peers as far as being a good, efficient operation? And really evaluating the management basically with this, using financial measures to measure management effectiveness. So this is a good way to see, maybe it's a good company, maybe it's got some good other ratios, but how effective is management in running this company? As we know in business is all about managing scarce resources, right? We can't just add tens of thousands of more people to a payroll. We have to manage these different scant resources of people or personnel or equipment or whatever it might be. And the efficiency ratios will help us to look at that in a closer way. So looking at all these ratios together, you're going to look at these companies, you're going to compare them with the industry. Some ratios might be more impactful for particular industries or companies than others. Things that are looking at dividend paying stocks, for example, dividend based ratios are very, very important. But if it's a company that is a growth company, a high fast growth company, and they don't pay a dividend at all, well, then dividend ratios aren't very important at all to that type of company. By the same token, in certain industries, like turning over inventory or carrying low amounts of debt might be important for some industries, like inventory turnover is real important to like a retailer, for example, versus other types of industries. All right, so that's a quick overview of these different types of ratios and what categories they fall into. Now let's go into each category and see some of the key ratios that are out there that are really effective within that category. There's thousands and thousands of ratios out there. We can always keep continuing to add them, but these are some of the key ones we're going to look at that really every investor should be aware of. And let's get started looking at these different ratios.